Hi, this is Mark Allen with GREA, and today I want to give a little bit of a market update of what we're seeing. Call it May of 2022. Today is May 3rd. That being said, unless you're hiding under a rock, everyone knows that interest rates are on the rise. With rising interest rates and a higher cost of capital, there's diminished returns. So that being said, there's a lot of owners who plan to sell later in the year who are moving up that timeline to sell to just beat the rise in interest rates. And that being said, because of that, we have an influx of inventory that's hitting the market. And at the same time, I'm going to peg it probably 10 to 20% of the buyer pool is sitting on the sidelines. And they're sitting on the sidelines more so, I'd say they're selective on the deals that they're pursuing or just waiting for the interest rates to stabilize. All that being said, with regard to demand, multifamily is still the poster child of commercial real estate, if you will. So we have incredible demand, there's a ton of liquidity, and it is the best inflation hedge. So we still do have record levels of demand, and we're definitely seeing that. That being said, offers and tours are down compared to last year. I think, again, part of that is there's just so many deals on the market, so buyers are having to pick and choose which deals to pursue. And number two, there's a little bit less demand. So I think the brokerage you choose as a seller is very important in today's market, specifically, choosing a brokerage with a big team that can make the necessary calls and have the necessary interactions to keep buyers focused on the opportunity. Each property is going to have a little different level of attention. Some properties that have had long-term ownership and there's real true upside are naturally going to get more attention than those that have traded hands 3 times in the last 6 years. I want to talk a little bit about price credits. With regard to price credits, I'm hearing from our national offices across the country in Atlanta and Houston, Portland, so on and so forth, that there are deals falling apart. There are deals that are a little bit rocky because with the rise in interest rates and the changing debt market, the buyers are asking for price credits. Here in Dallas-Fort Worth, I don't think we've seen as many price credits. Just talking to some of my friendly competitors out there, I don't think we've seen as many in Dallas-Fort Worth, and I think it's attributed to the level of rent growth that we're experiencing, but also the demand. That being said, within our office, I think we have 30 properties under contract right now, and one of those has seen a retrade or a buyer ask for a price credit. In that situation, the seller did not want to give a price credit, so the buyer said, well, I'll move forward at the contract price. However, I need additional time to go find a different debt source. The seller, was basically willing to give him more time should the buyer release their earnest money deposit, in which case they're having a hard time swallowing. So, anyways, there's going to be different deal dynamics. Every deal is a little bit different between seller, buyer, and property. But I don't think we're experiencing the amount of retrades as some of the other markets are seeing. As far as the debt market, we're seeing a lot of buyers still take floating rate bridge debt. They are paying up for cap costs and specifically just higher strike. As far as the debt market, we're still seeing a lot of buyers take the floating rate bridge debt through debt funds or balance sheet lenders. And that being said, they are factoring higher closing costs because the cap costs have gotten so expensive. I think most are targeting kind of that 2% strike premium, but that could change here in the near future. As well as a lot of buyers, whether they're local or out of state for that matter, are working with relationship banks or community or regional banks because a lot of them want to hedge against the risk of floating rate debt and a rising rate environment through just fixing debt today in the 4% range. So a lot of banks are offering, fixed at 75% LTV, 4.25%, 4.5% interest rate, at least today, and getting the leverage that a lot of these syndicate groups need. All in all, in Dallas-Fort Worth, I think we're going through some interesting times. That being said, there's still incredible demand. Like I mentioned, multifamily is the poster child. A lot of deal sponsors or those that are actively buying deals are having to educate their investors that that 8% coupon on workforce housing or 8% plus is now likely in that 5 to 6% range over an average hold of 5 years. So I think there's an education aspect going on between the general partners and the limited partners. That being said, I don't think it's really deal dependent, at least what we're seeing. We're not seeing much of a change in pricing. Now, as rates, if they continue to climb, we may see some pressure on cap rates in the future. But at least in the near term, really deal by deal dependent. I am hearing that deals are being repriced as far as just the higher cost of capital and higher closing costs, and that's changing pricing a little bit. But again, I think it's really deal dependent. I think all in all, the rise in interest rates will slow the crazy appreciation that we were seeing last year. In some of these assets, 20 to 40% growth. Which is just insane. So I think we see a little bit of that slow and appreciation. And again, I think it'll be dependent on where interest rates go if we start to see more cap rate decompression and price decline. Private capital investors out there, I think it's an opportune time to 1031 exchange. So a lot of inventory out there, so there's a lot of choices. You have opportunities to come in potentially with a preemptive offer, or even find a good off-market opportunity. And then again, with regard to potential rising rate environment, you can lock in low interest rate today, historically low, in the 4% range. Should you go bank or another fixed rate option? Again, this is Mark Allen with GREA. Thanks for tuning in today, and I look forward to working with you soon.